Hey everyone, welcome to the KE Report in a daily editorial on Friday, December 19th, chatting with Dave Erfle. Dave is the founder and editor of the junior miner Junky. Chat with Dave almost weekly, focused on the precious metals sector. And Dave, look, we had gold that hit an intraday all-time high yesterday, a little over 4,400. Silver continues to, in a way, rip higher recently, hit about $67 an ounce. Look, we can talk about just how strong these metals prices are. They've been in a bull market literally all year. You can make the argument for a couple years now, but I really want to focus on the underlying equities because I don't really have any data on this, but I do watch a wide range of especially gold and silver stocks, the whole way from the big guys down to the small juniors. And I've noticed the majors, they're still doing pretty well. A lot of those major gold producers are still right around those all-time highs. Some of the mid-tiers are doing fine, but on some of these big days that we've seen for gold and silver, big days up, I haven't seen much movement broadly in the stocks, especially in the juniors. It almost feels like some of the momentum has been lost, but again, you'd look at the metals prices and you would think these stocks should be popping much more. So maybe it's a tale of two stories here. I don't really know what to make of this, but other than it's already been a really good year and we are at the end of the year, but that still doesn't correlate with some of these big moves we're seeing, especially in silver day after day. What have you noticed, Dave, in terms of the stocks you're following and their reactions to, again, these continued breakouts in gold and silver?
Yeah, Corey, it's almost like a non-reaction, right? I mean, we had silver go up, what was it, $2 yesterday or the day before, and the stocks kind of went, meh, we're done, giving you massive gains. I mean, you got to consider the fact that, some of these juniors have gone up three, four, five times in a very short amount of time. They're wildly overbought technically, even though, they're still under owned and they're still very undervalued in relation to the metals that they're digging up out of the ground. But if you take a look at how far they've gone, there's probably some investors just saying, I'm going to take some profit off the table. And you take a look at when, in the past, the miners and silver have always led the gold price in both directions. Meaning if you have a strong gold price and the miners and silver are lagging, that's generally been an indication that, hey, we're about to have a correction. So if you take that into context, you see the silver price, it has gone, let's face it, it's gone parabolic. I mean, it hit $67 an ounce this morning, and it's wildly overbought. It continues to go higher. It's wildly overbought technically. So, like I said, I think it's just some profit taking at the end of the year and waiting for the next for the shoe to drop. I mean, because if you take a look at the silver price running to 49.50 back in 2011, and right after that, they raised margins across the board. I think they raised margins five times, and the silver price went down 30% in a week. They tried that last Friday. They raised margins 50%, and it didn't work. The silver price, hiccuped for about a dollar or two, and it moved right back up because I think the main reason is because this is a physical squeeze, not a paper squeeze, right? I mean, the 49.50 move in 2011 was speculative, right? It was speculators driving the price up to 49.50. But now this is a physical move. This is because this is the fifth year of deficits. Warehouses are empty. Everyone's scrambling for physical, so this is a physical move. So the raising margins, 50% on a Friday night where nobody can really react, hitting the speculators isn't really going to do anything. And it proved that because when it opened again on Monday morning, silver went right back up again. So I think people are expecting them to do it again this Friday, probably. They're probably going to raise margins again on Friday to try to cool the price action. I would imagine that's probably what it is.
Okay, Dave. So some people are just kind of front running the fact that if there's margin requirements raised again, which is what killed things in 2011. That'll take the wind out of the sails. But to the point you made, when they tried that last Friday, we were in the 63s for silver. Now we've been in the 65 to 67 zone this week. I'm a little less sanguine than you guys, though, about this. I guess I'm looking at it from the standpoint of think about the margin expansion going up a couple dollars in silver. That is huge for a producer. Think about the NPV economics on a development stage company. That's insane growth on the value of the projects. So to see silver stocks in the red doesn't seem just like profit taking and just a non-reaction. It seems like a broken reaction. It seems like something bigger is going on than just seasonality or profit taking. Is it that people are expecting a crash like we're talking about, or is that all year long silver stocks have not really kept track with this rising metal price?
Yeah, I mean, you factor all that in. Yeah, absolutely. I keep getting emails from people, saying, "Okay, the stock market's rolling over again. Hey, what's going to happen when the stock market crashes and it takes gold stocks down with it and takes all our profits with it? Should we sell? Should we sell? Should we sell?" That's not the way you need to look at this. I mean, gold now is the safe haven asset of choice from central banks, from retail investors. I mean, proven that, central banks are holding more gold now than they're holding treasuries. When we had the 2008 great financial crisis, everything was sold and everything went into the dollar was the safe haven. Well, I don't believe that the dollar will be the safe haven of choice when we finally do get a sharp move lower and we start to get some margin calls and some panic selling. Because like I said, gold is now the safe haven asset of choice. And for the first time in decades, it's being recommended by financial houses. Goldman Sachs, JP Morgan, 60/40 is now 60/20/20. So, and that's a huge shift. And we really haven't seen the end of that yet. I mean, we've just starting to see the beginning of it. This is retail investors finally getting into this sector after ignoring it for decades. So, I mean, as far as speculation is concerned, as far as a blow off speculative move in juniors is concerned, we're not even close to that. I think that's way in the future.
Dave, what about the assessment that a lot of these juniors, there's a number of them that have gone up 4 or 5 times from lows just in this year. Even if you go back to last year, these stocks have, in a way, gone vertical. They have re-rated. How do we judge what the, I guess, future re-rate could be in some of these names?
Well, yeah, I mean, just look at the ounces in the ground they have, how much they're trading for. Silver's trading at, $5 an ounce in the ground or less in most of these companies, and gold as well, $60 an ounce or less. And look at the NPV on their projects, which continues to go higher. Even base case NPV, these juniors haven't even reached base case NPV for their market caps. So you take a look at a company like Abra Silver, right? That's been in my top 10 for a while, and we've done really well with it. I mean, they've got 350 million ounces of silver equivalent, and their U.S. market cap is only 1.7 billion, and their NPV of the project at spot prices is 5 billion. So I mean, these things still have a long way to go. Corrections along the way, absolutely. Are some of these stocks due for corrections? Absolutely. But I don't think the corrections will last very long, and the weakness should be bought. And that's what you're seeing. You're seeing weakness bought quickly, which is why these things continue to climb.
Well, I think it's also interesting the analogy between what happened in 2011, or you could even argue 2016, where some of the stocks, silver and gold, got above their NPV valuations. Again, we're not even at base case. We're not even at their upside targets, and we're way away from spot prices, which are still above what their upside cases are. Isn't there a difference between being overbought on a chart and being overvalued? I mean, I think that's the big nuance here. Some things can be overbought on a chart technically. Sure, they need to rest. But when you look at their valuations, they're still a fraction of where they should be.
Exactly. Overbought, but underowned. That's the mantra right now people should have in the back of their heads when they're looking at a stock that they want to get into and they see it continue to climb, and they wait for weakness. They see weakness one day and they expect weakness to continue, but it's bought right away. I mean, I see that in so many stocks, so many of the stocks we own, so many of the stocks that I follow. The weakness doesn't last long because these stocks are underowned. The minors are underowned. I mean, the juniors are still vastly underowned. I mean, just take a look at the TSX Venture. I mean, when we had going into 2008 financial crisis, right? We had a speculative bubble in the TSX Venture. It went to 3,300. Okay, the venture now is barely bumping up against 1,000. So, and gold is trading at 4 times what it was back then. So these things still have a long way to go. I mean, and as far as worried about getting in early, sure, if you get into something that's gone up a lot and you buy it and it's down for a day or two, the bull market is going to bail you out. Just in bear markets, you have the opposite effect. You try to get into something as cheaply as you can, and if you end up chasing something after it's gone up a little bit, you end up selling it for tax loss. But in a bull market, the bull market ends up bailing you out not too much farther down the line if you get into a quality company that is de-risking a project that is still vastly undervalued in relation to its NPV at base case prices, let alone spot prices.
Dave, any valuations out there then that make sense to you? Anything that we should be benchmarking here and now rather than saying that the whole sector is undervalued? Any stocks that you see as being fairly valued so we can maybe use those as a barometer of where stocks, whether developers or producers, could go?
Well, sure. I mean, there are some fairly valued companies out there, but not too many because, like I said, the metals keep going higher. And if you take a look at where the metals went in Q4, as opposed to Q3, and these miners are going to start to report their financials, their fourth quarter financials in February. They're going to be off the hook again. So, I mean, I know we were worried last time that a lot of that upside, that upside in margin was already priced into some of these stocks, but it didn't turn out to be the case. They just keep going higher. But as far as where the biggest value is right now, I think it's in the higher risk juniors. I know we've talked about this before. That's the companies I'm focusing on now to get into when, I'm trimming profits on companies and I'm using investment capital to get into higher risk juniors. I mean, higher risk juniors being companies that have recently announced a maiden resource, or they're about to, or they've just announced a PEA and the market really hasn't caught on to it yet. These are and also companies that maybe are in higher risk jurisdictions, and maybe something positive has happened in that higher risk jurisdiction. Bolivia, for instance. I mean, I've stayed away from Bolivia for a very long time, but recently I've gotten into a Bolivian silver junior because I like what's happening with the politics there. They just elected a more right-leaning president, and it's getting a little better there in Bolivia. And some of these stocks are just dirt cheap. They have yet to catch up. So companies that are trading in higher risk jurisdiction, and maybe some positive things are happening in that jurisdiction, they need to catch up. And some of these companies are starting to catch up. So you're starting to see these companies up on days like recently when you see the sector down, like the day that silver went up that $2 and the stocks really didn't do much. This Bolivian junior that I got into was up on the day, and it's been up because it's breaking out of a huge 3-year base, and it's still vastly undervalued to its peers because their projects are in Bolivia.
Yeah, it's a good point. We've actually talked to a couple companies operating in Bolivia just over the last week or two, and it is a change on the ground there. And I haven't seen any problems in that jurisdiction from the handful of companies that are operating there, and even the private companies operating there. Doesn't seem to be so. Sometimes the jurisdictional risk is a little bit overblown as far as how it shows up in the valuations. But I want to circle back to what you said about the quarterly earnings. I know we talk about this almost every time, but I continue to be stunned, amazed, and disappointed that people are not factoring in the record revenues that are going to be generated this quarter, and they just keep getting more eye-popping. If you thought October was good and the pullback into November was, a little bit bad, that was still way higher than in Q3. But since mid-November to through December, the prices of gold and silver have been so high, and the profit margins are so big that if you look at a PE ratio, it's price to earnings. Well, if the earnings are going to jump up, by a huge factor when we get those in February, to your point, Dave, if the E is going up, shouldn't the P be going up? Or are these price to earnings ratios going to be down in the single digits?
Yeah, I mean, there lies the opportunity, Shad. I mean, silver is averaging $52 an ounce quarter to date. I mean, think about that. This is a metal that hadn't been able to get above $50 an ounce for 45 years, right? It had been strong resistance for 45 years. And now it's averaged $52 an ounce in Q4. I mean, these companies are going to be reporting massive amounts of free cash flow. And gold, I think gold has averaged $4,300 in the quarter, something like that. I don't know the number off the top of my head, but yeah, I mean, these things are just going to be producing massive amounts of even more free cash flow. And I think this is the fourth consecutive quarter that they're doing so. This sector is finally starting to get some attention because it's outperforming everything else. And then on the other hand, it's been lagging for so long, and investors have ignored it for so long that, hey, maybe it's about time to start taking a look at the gold sector, because general equities are wildly overvalued. They've had a huge run, and these gold miners are just starting their run.
Hey, this sector was in a bear market for a long time. Everyone was looking elsewhere, but we do have talked to a lot of generalists that are positioned in not necessarily the individual names, but the ETFs. Dave, in this environment where, yeah, it seems like all producers are making money right now, is scale important then? Do you just like the ones that are producing more because their free cash flow numbers should be better? Or do you like the little guys that are still grinding out, let's say 10, maybe $20 million a quarter, but quite frankly, it's better than the losses they were taking over the last however many years they were in production?
Yeah, well, as far as my newsletter is concerned, Corey, is juniors, and at the bottom of the pyramid in my portfolio are growth oriented producers. So I like the growth oriented producers. They got massive growth ahead, and they've just started producing cash flow. I mean, those are the ones I really like to see, because when you're in that Lassonde curve and you're constructing a project and it's just about to produce free cash flow, and maybe you have another project or two in the pipeline, that is huge. That is very, very huge for a growing company.
Well, Dave, as far as we've talked about the producers, let's shift into the developers. It's hard to define the term because most people at least have it as a company that's at the PFS stage, the pre-feasibility, or the feasibility stage, or maybe they're at the construction decision, then they're definitely a developer. But are you finding yourself going down into earlier stage companies and into the PEA and PFS stage companies? And are those even still developers, or are those advanced explorers?
Yes, I consider a company going from the exploration stage to the developer stage as soon as they've released a positive PEA and they're on the road to a PFS. So those are the companies I really like right now, and even earlier stage. I think I've told you in the past, I just recently added my first drill play for the first time in like 3 or 4 years. So, and there's other companies that are on my watch list now that I like, that are looking at putting out an updated mineral resource on the way to a PEA within the next 6 to 8 months. I like companies like that if I like the project. And I think that's where the big upside is now. So when you in bull markets, it's the majors, the royalty plays, they start moving up first, and then it's the mid tiers, and then it's the late stage developers, and then it's the feasibility stage. So now, you know, people are going down the food chain looking for value. They've done really well in these lower risk juniors, and they're taking some profit off the table and looking for what to get into as far as the higher risk, going down the higher risk totem pole, the food chain in the juniors.
So, Dave, one more, then I'll get you out of here. Quite frankly, this year has been, in a way, historic in a good way because of just how strong the metals prices has been. And quite frankly, the stocks have also performed very well. And in a period for essentially kind of the back half of this year, outside of maybe the last week or two, the stocks have been outperforming the metals. Silver has kind of changed that with some of its skyrocketing move. But looking in 2026, could we expect another banging year just like we had this year? Or is that maybe asking a little too much?
I think it's asking a little too much. I mean, what, silver's up 130% this year and gold's up 65%. And, this is the first year since 1980 that copper, gold, and silver are all trading at all-time highs at the same time. And it's the shift from paper assets to real assets. And I think that's going to continue into 2026. People are losing faith in the Federal Reserve. They're losing faith in the financial system. The geopolitical situation, I don't see it getting better in a lot of these places. And as far as the Trump administration is concerned, he's going to announce his yes man at the Fed in early January, and that basically makes Powell a lame duck until his term is up in May. And this is just an inflationary environment where hard assets are going to continue to thrive. But on the plus side, these minors and especially these juniors are going to continue to re-rate and play catch up to where they eventually become fair value. And I don't even see that the fair value happening, in the first half of 2026. I think they're still going to continue to play catch up. So, but on the other side of that, there's a 10 to 20, there's at least a 20% correction in the gold price coming at some point. And, all we've had so far is like 10, 11% corrections in this run. So, once it reaches a point where it's finally time to have a decent sized correction, it's going to be interesting to see how the stocks react and how long they start to show increased profit taking. I don't think it's going to last that long because, like I said, this sector is still massively underowned, even though it's technically overbought.
All right, Dave, we'll wrap it up here. Thank you for all your time this year. It's been a pleasure keeping up to date with the precious metal sector with you, mostly because it has been just a screaming bull market. Way more fun to talk about stocks going up than stocks struggling like we had been for a number of years, but does seem like a different environment. Who knows how long it'll last, but seems to also be ending the year on the right foot, at least in metals prices. And yes, I know some of the stocks are lagging right now, or the juniors are at least, but I don't think we need to worry too much about that right here and now. Maybe if it continues for a few weeks or a few months, then maybe more of a concern. So let's see how that all plays out. If you want to follow along with Dave, just click that link in the show notes or search Junior Miner Junky. That's his newsletter, which Shad and I both get, and it's great reading over it on a weekly basis. Dave, thanks for all your time this year. Happy holidays, happy new year. Chat with you in 2026.
Thank you, guys, and thanks for having me on over the course of the year. It's been a pleasure speaking with you and your audience, and I wish all of you out there a very happy holidays and a very happy, safe, and healthy new year.